In the world of ETFs, most investors either choose dividends or growth, but rarely both. What if there was a way to combine aggressive monthly income, solid blue chip dividend stability, and long-term capital appreciation into one simple 3 ETF portfolio? This is the 3-fund portfolio consisting of MSTY, SCHD, and SCHG. This mix blends MSTY for the ultra-high monthly cash flow, SCHD for the reliable dividends and dividend growth, and SCHG for long-term capital appreciation through quality growth stocks. So let's break down why this mix works, how each ETF plays its role, the risks, and how much income and growth you might expect from this portfolio. So let's go over each of these ETFs. The first one is going to be MSTY, the Yield Max MSTR Option Income ETF. It's a covered call ETF based on MicroStrategy stock MSTR, and it yields a very high distribution rate of 144% currently. Now this distribution rate does fluctuate because it's very volatile, and it's going to range between 60% and 150% annualized. And of course, you're getting those monthly distributions, which is going to help for that ultra high monthly cash flow. Now, the objective of this ETF is to maximize income from MSTR's volatility, and that is why we have such a high distribution rate. The more volatile MSTR is and Bitcoin, the higher distribution rate we are going to have, because this is a covered call ETF and it has high income through the option premiums. Now, this is going to be a very high risk ETF. It is directly tied to Bitcoin via MSTR, and of course, those are very volatile assets. And unlike the other ETFs on this list, this is a single stock ETF, so it's directly only going to be holding MSTR exposure. Now, the second ETF in this 3-fund portfolio is going to be SCHD, the Schwab US Dividend Equity ETF, which tracks the growth of 100 high-quality dividend-paying U.S. stocks, and it has a very low expense ratio compared to the other ETF on the list. The strategy with this ETF is very straightforward. It's low cost, offers tax efficiency, it tracks an index focused on quality and sustainability of dividends, and it's very diversified because we have 100 high-quality dividend stocks. If we take a look at the top 10 holdings, we can see that we have Coca-Cola making up 4.34% of its portfolio, Verizon, we have Altria Group, Cisco, Home Depot, Chevron, and AbbVie as some of the top 10 holdings, and no more than one holding has more than 5%. So it's very diversified and equal weight. Now, the dividend yield might seem pretty low compared to MSTY. It only has a 4.03 distribution rate, and that is considerably low compared to MSTY. And this ETF also pays out quarterly versus monthly. But this is a very low risk ETF, and it's blue chip focused, and it's an ETF that you can continue to buy and hold whenever the market is high or low, and you know that your investment will be safe. And this ETF is particularly good during the stock market crashes because we're holding 100 high quality dividend stocks, which are very defensive, especially during recessions. And the third ETF on this list is going to be the Schwab US Large Cap Growth ETF, which tracks the growth half of the Dow Jones US Large Cap Index. It has a low expense ratio of 0.04%, and it's also tax efficient. Now, while this isn't a dividend-focused ETF, we do have a dividend yield of 0.44%, and it is distributed every single quarter. You're investing in this ETF for its high growth potential. If we take a look at the top 10 holdings, we can see some amazing growth technology stocks such as Microsoft, Nvidia, Apple, Amazon, Meta, which have done phenomenal in the past 5 years. So in my opinion, this is a very balanced ETF mix of MSTY, SCHD, and SCHG. You have the high monthly cash flow from MSTY, the defensive, reliable dividends from SCHD, and you have high capital appreciation from SCHG. So we're basically combining the best of 3 worlds. The first is going to be the monthly passive income, the second is dividend safety, third is going to be long-term stock appreciation. Now let's say you invested 30% or 30,000 into MSTY, 40% or 40,000 into SCHD, and 30% into SCHG or 30,000 for a sample $100,000 portfolio. With MSTY, we're going to assume that we're hovering about 80% yield, which is a little bit conservative. So we're going to be taking home about $2,000 every single month. But the variable is going to be the income, as it's going to be changing month to month because it's an actively managed fund and the option premiums are going to change every single month. Now with SCHD, we're going to assume a 3.5% yield, which is going to give us an income of about $1,400 every single year paid quarterly, which is not that high, but it's going to be reliable and it's something that you can always stick your money into. And it has strong historical total returns of about 12% annually. So it's very reliable and stable. Now with SCHG, we're going to have 30,000 to that, and the yield is only going to be about 0.4%, which is going to give us an income of $120 per year. But we're going to be having that long-term capital growth, which is not an income-focused ETF. If we take a look at the charts, especially SCHG, we see it's up all time of 748%. And that's really why we have this ETF in this portfolio. We want that unlimited upside potential because MSTY is capped because of those covered calls. As we can see, it's rebounding between $20 and about $30, $40 per share, but it's an income producing asset of 100%. In SCHD, you're pretty much getting the best of both worlds. It's very defensive. We have a 4% dividend yield, and we also get that stock appreciation, and we have a total return of 210% in capital appreciation alone. So by having this 3-fund portfolio of these 3 ETFs, we're not going to be blowing up our account because we're too concentrated in one sector. Sure, in a recession, we're going to be losing in share price from SCHG, and we're going to be losing in MSTY, but MSTY is going to still produce dividends, and SCHD is not going to lose as much in the share price, and we're also going to be getting that reliable 4% dividend payment paid out every single quarter. Now we also have to consider taxes. So MSTY's income is taxed as ordinary income because it's purely options based. So you're going to be paying the most taxes on MSTY, as well as we have an expense ratio of 0.99%. So a lot of fees and taxes to consider with MSTY, but with its high dividend yield, it basically offsets all of that. And it's one of the most popular yield max ETFs for a reason. With SCHD, it mostly pays out qualified dividends. So you're going to be taxed at a lower tax rate, and it's going to be taxed mostly as long-term capital gains, which is a very low tax bracket compared to ordinary income. And with SCHG, the growth is unrealized until sold. So you can have a better tax deferral with this ETF. I had to choose where to put these ETFs in a brokerage account. I would definitely have SCHG in a Roth IRA so the capital appreciation can continue to grow tax-free even when I decide to sell. For a taxable brokerage, I would put SCHD as well as MSTY in that brokerage. SCHD is very tax efficient. Those dividends are qualified, and MSTY is an income producing asset. It's not going to have much capital appreciation, and we're just going to be paying that ordinary income on this dividends. Because remember, this is an income focused ETF, and people are using this ETF to pay bills or just reinvest it into other stocks. While MSTY gives you immediate income, the true power of this portfolio comes from combining it with stable dividend growers and long-term tech stocks. Imagine this, MSTY gives you $2,000 per month now, SCHD grows slowly, reinvests its dividends, and buffers volatility. SCHG quietly builds long-term wealth in the background, and in 10 plus years, even if MSTY fades, SCHD and SCHG may carry the portfolio forward. So the MSTY plus SCHD plus SCHG portfolio is a powerful balanced solution for ETF investors who want income today and growth tomorrow. MSTY gives you that cash flow with its high dividend yield. SCHD gives you the foundation, and SCHG gives you the future growth. It's simple, flexible, and surprisingly effective.